Joining us now to talk about Friday's hot jobs numbers and implications for the markets and the Fed, Greg Branch, Veritas Financial Group managing partner and a CNBC contributor, and Lara Rhame. She's FS Investments chief U.S. economist. And thanks for joining us. And Lara, now I'm worried about the cuts, and we've been saying it all along. And I mean, obviously, it's hitting us over the head that maybe we got ahead of ourselves there. How many will there be, and when will we, in your view, when will the first one actually come? And how important is that? The market has shrugged it off, continue to hit new highs. Why?
Well, I think you bring up a really good point, which is, can we make new highs if we're not going to get these immediate and satisfying rate cuts? I think the answer is yes, because the data remains so strong, and things like productivity growth are still not only above expectations, but really a leader in the developed world. I am still in the camp that we're going to get surgical rate cuts only in the second half of the year. Just given where the data are, there is not the urgency to cut rates, even though I think that this is going to be the discussion that's going to keep, markets pretty volatile. The other thing we have this week is a lot of Fed speakers. So I think this topic is going to dominate market activity this coming week and beyond.
Greg, we've had people on in the past, and I said, what do you tell your clients when, if they've listened to you, they really, all these new highs, they keep missing these. And we had one guy on who actually said, I tell them about the strength of my arguments that were totally wrong, but they were really well-founded. And I tell them, I had a really good reason for guiding you in the complete wrong direction. So now we're more new highs, Greg. Do you shake your fist at the markets because it's so stupid for not doing what Greg Branch said it should do?
No, absolutely not. And that argument offers no solace to clients. The key is always finding where there is going to be relative strength. And this is going to be the tale of two markets. You mentioned all the names reporting this week. And when you compare that to the names that reported last week, I think you're going to see a very bifurcated earnings reality. And so the Magnificent Seven, or at least those that are tethered to AI and cloud, they're going to grow earnings at 25% this year. There's going to be little else that grows anything above single digits. And so, like I said, that distinction was very marked in what we saw reported before we saw last week's report. Before that, we were coming in with 70% of the S&P having reported at negative 1.6% earnings growth. After last week, we're now at 2% earnings growth, which is closer to where we'll end up. And so the key is finding those things where you can have your equity exposure. And as I've long said, I expect breadth to re-narrow around those names tethered to AI and cloud, those secular tailwinds. Some of the Magnificent Seven is part of that. Obviously, some of Semi's world is part of that. Cybersecurity is part of that. And I believe that multiples won't really start to matter when the difference between the earnings growth we see there and the sectors that are more exposed to the slowdown that is coming. I believe that the distinction will be clear and investors will flock there regardless of the multiple. So that's a safe place to hide, and that's what you have to do for your clients when you're as bearish as I am.
Your clients that are still saying, Greg, I'm with you. I understand, this is a tough business, but do they say what do they say you've done? What advice have you given them that they say was great? Did you tell them if you have to hold your nose and buy, this is what you should buy? Because we're at almost 5,000 on the S&P. I think you were talking still in the threes with the three handle is where you thought the S&P should be, right? You're 1,000 points off on.
Let's make sure we have the whole argument. Let's make sure we have the whole argument here, right? And so in 2021, I said that the Fed should come out of Jackson Hole and raise rates. When they didn't do that, and I think we all now universally see that that's what they should have done, in January of 2022, when the S&P was at 4,700, I said indeed that the S&P should be at 3,800, and that's almost exactly where we ended the year. So most of my clients have been with me for longer than the last few months, and they appreciate that they didn't lose 20% on their money based on those dire warnings. Now, that said, have I underperformed relative? Of course I have, because I haven't had full exposure on. But I have also been warning along the way that there are pockets of strength that we can take advantage of. Those pockets have been strong. And so it has not been a cataclysmic event for my clients.
Lara, at this point, if you were to go to Costco, I just hear some anecdotal evidence that the jobs numbers that we're seeing, that there may... I've almost given up on looking for recessionary signals or slowdown signals. And when people throw in the towel and say there's never going to be a recession, I guess that's when it'll, what everyone was saying, waiting for one for the last year, and it never comes when you're looking for one. Are there any signs of weakness that you see that are being masked by, for whatever reason, these strong job numbers and these GDP numbers that no one was expecting?
You're not alone. I think a lot of us, and myself included, are still expecting a slower economy. And last year, after you see the Fed being the most aggressive that they've been since the 1980s, we're very worried about recession. I put myself in that camp. I think looking ahead right now, you have to squint to see weakness in the economy. One place that is still apparent is in the bond market with that inverted yield curve. And I think a theme for the coming year is going to be this margin squeeze on banks, concern about the banking system. When I look at what could trigger the Fed to cut rates, the data as it is today is not the trigger. The trigger could be some news about banks. But at the end of the day, my forecast is a slower economy. But as far as recession, I think the good news is today, with the Fed funds rate where it is, if the economy does start to slow, there is room to bring rates down. So it's hard for me to be pessimistic, but growth where it is today is just unsustainable. It's got to slow from here. That's what we're going to have to navigate with these very high valuations.
When did the yield, do you know the date when the yield curve inverted? How long is it supposed to be, Becky? We've said that so many times.
Passed already.
Is it way past? It didn't happen. Yeah. It's supposed to, if a yield curve inverts, you're supposed to have a slowdown or a recession within a certain amount of time.
18 months or something.
Huh?
Like 18 months or something, and it's been way longer.
Yeah, 18 months. It depends on where you look, but we're coming up on 18 months for that 3-month 10-year. So, yeah, I think, they're big.
Doesn't work.
Questions.
It didn't work. It's not working. Throw it out. It's the NFC, AFC. Nothing works forever, except do the opposite of what most people say. That's the only thing that works.